Dhananjay Sinha, the Chief Strategy Head of IDFC Securities is here. Dhananjay, good afternoon. Thank you very much for your time. Long chatting with you. As a strategist, how are you looking at the market right now? You look at macros also very closely. First of all, in short, how weak are the Indian macros right now?
So I think definitely there has been a lingering concern on consumer demand, and especially with respect to discretionary spending, and that reflects in a very steep decline in the auto space. So I think that is one angle of it, and there is a sort of impact of that across sectors that are dependent on it, and a lot of informal sectors actually dependent on it. The other thing is that there does seem to be a sort of a spillover effect from what is happening globally. From a global trade standpoint, there has been a decline in value and volume growth, and that is sort of percolating to activity, subdued activity in India as well. So that is another angle. Third angle, I would say, is that with a sort of volatility in commodity prices, and also the fact that the top line is impacted because of top line growth is impacted because of that. There has been a weak tax collection for the government, and that is impacting their spending ability. So that is also impacting the demand side. So some of these things are seemingly fairly entrenched, and while the government is trying to tackle this through some policymakers, if you include RBI as well. So there has been a sort of a preemptive plus lagged reduction in lending rate, plus other things that have been done from a regulatory easing standpoint for NBFC sector, and other measures that RBI has taken. So they are trying to confront it by taking such measures. What the market is also waiting for is what the government can do to facilitate higher spending by way of higher government spending, or possibly increasing be more liberal on the fiscal deficit target, and also some reduction in the GST rate. So effectively, the market is now expecting that the second leg of the stimulus by way of fiscal measures should come around. So I think you have a fairly surprising downtrend as far as discretionary spending is concerned, big ticket spending is concerned, and it's kind of percolating, and it is the other side is what the policymakers can do. So I think the market is actually waiting for that to happen.
How long could this wait be? Because okay, let me understand from you. Even if government does blink and hands out some amount of stimulus, because government's own hands and financials are restricted in its own way, even if they do, how much lag effect would it be showing in the real system, and with how much lag will the machinery actually start moving on the ground?
So the thing is that if this is more like a revenue spending growth, so the impact of that is roughly about, for every 100 basis point spending growth in government consumption spending in real terms has a 150 basis point cumulative impact over 12 months. And this sort of becomes strongest in a period of 6 months. So if the government starts becoming more easy on the spending side, then we can actually see this in let's say 3 to 4 months' time, that the impact will start becoming visible. So I would say that if the government adopts more of a revenue spending approach, then the impact can be fairly soon. The same is the case if you have a sort of a reduction in tax rate. But I think what the government would eventually do is more on the spending side, less on the tax rate cut side, because that's largely within the ambit of GST, and a lot of measures have already, rationalization has already taken place. So I think there is an incremental change that might happen there, but larger thing to really look at is what the government can do from a spending standpoint, because the thing to understand is that the slowdown has been aggravated when the government suddenly clamped down on its spending, and there are a lot of overdues that might be there. So unclogging of those liquidity tightness can actually have an impact in the immediate term, maybe 2 to 3 months' time.
A lot of public sector banks whom we have been interacting with are already releasing this liquidity. NBFC is also saying that availability of liquidity is much better now. And yesterday we did see a very big commentary from RBI governor as well in that direction. So if that were to happen with say 6 to 8 months kind of a horizon, as a strategist, what would you tell your clients to go about portfolio strategy? Would we get 6-8 months to look for good value, or
So
do you
the
think
thing is-
the market will rebound faster?
Yeah. So the thing is that I mean, this is an anticipated framework that we have looked at, and we are saying that that whatever we are seeing from a consumption standpoint will be will be countered to at least some extent by more fiscal spending, because we do not have any grip on what is happening on the global front, and what happens between US and China is something which is very difficult to forecast. But if you look at India's standpoint, we are saying that the slowdown will be countered by stimulative measures. We have already seen that from RBI happening, and RBI is nudging the PSU banks to transmit the rate cuts more rapidly than before, and that will stimulate more leverage, consumer spending. Maybe it will be largely consumer spending. There is a focus on lending to agriculture sector, MSME, and housing. These are the sectors wherein there is an interface between the banking and the NBFC sector. So there is a measure that has been relaxation that has been given also for personal loans. So clearly what we are anticipating is that as some of these measures start to sort of filter in, and also alongside if the government starts to ease on the spending side, there might be some the pain points with respect to the consumer non-discretionary may start ebbing in the next let's say 3 to 6 months time. So what we are how we have positioned our portfolio is on the one side we are saying that the currency will depreciate because of the global factors, and also that we anticipate widening of current account deficit, that the rupee we are saying will continue to depreciate. Our interim target is 70 to 73, but I think we are already there. So the downside pressure to currency is still there. So my overweight is significantly in the IT space. So you can pick your stocks, but we are overweight on the IT space. Secondly, we believe that as the government spends more, and we believe that a lot of the welfare schemes or entitlement schemes that the government has will be honored, and hence there will be higher disposable or at least a better traction in disposable income growth going forward. So we are also sort of overweight on the FMCG pack. So in our theme, what we have said is that stocks that such as HUL and Dabur and Marico are the 3 stocks that we have chosen, and in the electric consumer durables we have highlighted Crompton Consumer. So these are stocks that we believe can have a traction if the government starts to spend. If the
Let me interrupt you over there a little bit.
Or retail lending happens as we are anticipating. Sure.